Hi, today I'm looking at Seritage growth properties, which I've been watching for a few months now. The reason I'm wanting to dive a little deeper is because three of my favorite investors have big stakes in this company, and I just wanted to find out why. Now, if you are new to my channel, well, welcome. My videos are about investments that anyone in the world can make. I'm trying to help as many people as possible understand what it is they're actually investing in. See, most people spend far more time researching their next computer or TV than they do their next investment. Now, I've built a reasonable sized investment portfolio that I'm aiming to continue growing at about 20% per year. Well, that's the goal. I've based a lot of my knowledge on the great investors, Peter Lynch, Warren Buffett, Charlie Munger, Mohnish Pabrai, and a handful of others. Now, I'm not perfect at this. Not every investment that I make is going to be a home run, but we definitely will find some great investments and push for that 20% goal. All right, now let's get into Seritage growth properties. So Seritage is a real estate investment trust, essentially, which means it pools a large amount of real estate together and tries to give most of the profit back to the shareholders. It was created a few years ago to buy and redevelop old Sears locations. Sears is a retail department store chain in the USA. If you didn't know, it's kind of like you might have a Target or a Kmart in your country. It's like those. Seritage is a classic deep value play. The idea behind the business is to take old Sears locations and transform them into modern mixed-use properties that command high rents and create value for investors. Of more than 2.8 million square meters or 30 million square feet of real estate, Seritage has successfully redeveloped about a third of that so far. So it's pretty early on in its execution of its vision. Seritage's main problem is financing. Its sole creditor is actually Berkshire Hathaway, which gave Seritage a $1.6 billion term loan plus a $400 million credit line to fund its redevelopment efforts. Now, the problem is that Seritage cannot access the credit line until it achieves a certain level of non-Sears rental income. And with the perfect storm of an earlier than expected Sears bankruptcy and the pandemic, it isn't likely to get there anytime soon. Now, it has been able to sell some assets to buy some breathing room, but it needs to find a sustainable funding source. Now, actually, even before the pandemic decimated the US retail industry, Seritage was struggling to redevelop properties as fast as Sears and Kmart were vacating them. See, the pandemic has made what was already quite a tough task, well, it's now even more difficult. Many of the new tenants that Seritage was counting on to replace the income that was lost due to Sears and Kmart stores closing temporarily stopped paying rent this year. A few even went bankrupt themselves or cancelled previous expansion plans. So as a result, Seritage's redevelopment plans have stalled for the most part, while it continues to just burn cash. They have turned to asset sales to get through this period of weakness in 2020, so like selling off some of their properties to stay alive. It appears to be continuing to do this strategy in the third quarter as well. So Seritage simply doesn't have enough tenants in place yet to cover its weekly and monthly costs. Now, although they're selling properties, they are not in liquidation mode. Now, they are just selling off pieces to keep this redevelopment dream alive. They have deals in place for rental income to start coming in, and if that happens soon, well, Seritage will be at break even by probably the end of next year. But while we wait for this to unfold, Seritage is burning cash. And the question is, how long can they keep this up? And is it possible to value the business? Okay, now before I go any further, I would like to know if anyone actually is enjoying this video. So if you could hit that like button for me, I'd love the feedback. Thanks a lot. Okay, so you might be thinking like I was thinking, this all sounds like a mess. And well, it is. But there must be something going on here because three of the smartest investors have invested heavily in this turnaround story. You have Warren Buffett's Berkshire Hathaway, who holds that debt, and Warren Buffett himself personally owns about 5% of the company. Then there's Mohnish Pabrai, one of my favorite value investors who runs the Dalal Street Fund, has over $50 million invested, making up 36% of his entire US fund. Then we have Spier at Aquamarine Capital. He has 4% of his portfolio in Seritage. Now, instead of digging through this company myself, I luckily didn't have to do this hard work as Brad Kellner has done a lot of this hard work for me. I'll put a link here to his channel. Look, thanks mate, I appreciate the big effort you put into this research. Now, Brad went through the 170 properties that Seritage own, and here is a summary. They have about $3 billion in land value, and that's estimated based on comparative properties in the area. They have $1.3 million per acre on average, maybe another $300 million for the 28 joint venture properties. They have $1.6 billion in debt from Berkshire. There's 70 million in preferred stock and 56 million in shares outstanding. All right, so let's try to value this thing. So we have the $3 billion in land, the 300 million in joint venture assets, minus the debt, minus the preferred stock, and divided that by the $56 million shares outstanding, and that gives us our book value per share of around about $30. The worst case scenario is what I call a slow death. And what I mean is, over the next 5 to 10 years, management can sell off assets little by little and don't find a way to turn profitable. Even though they have a lot of assets now and it's worth about $30 per share, if they keep losing money and selling assets, this number is just going to get less and less. So how likely is this to happen? Well, I have really no idea. But I think if the world returns to some sort of normality, then this situation is going to be less likely. They are planning to be income positive by the end of 2021. But look, there are a lot of variables here. Another shout out here to Investing with Tom. I'll put a link to his YouTube channel just here somewhere for doing the next calculations, which will let me explain more downside issues. Now, if the value of the assets fall, which in real estate is obviously a possibility, like in 2008 when real estate got absolutely hammered, let's use this 2008 crazy time as a good worst case scenario. So in that 2008-2009 period, the commercial real estate prices went down about 30%. Now let's use that and see what happens to the book value of Seritage if this was to happen again. So we have $3.3 billion of current value, multiplied by, well, 0.7, which would be a 30% fall in value, to give us $2.3 billion. Then we get the minus the debt out of that 2.3 and the preferred stock, divided by the 56 million shares outstanding, and that gives us $11.42 book value per share. Now that's remembering a 30% decline in the asset's value. So as Seritage sells off some of their assets little by little, then this book value will get less and less as well. Now, I'd love some feedback on this video so far. Please hit the like button for me so I can see if this video was interesting or not. It will help me a lot, so thank you. Okay, so now we have got through all the downside risks. Let's take finally a look at the upside. So firstly, Phil Town, who is a famous investor, he thinks Seritage is going to $140 per share in the next 10 years. So he's based that on when Seritage gets all their properties developed and they're producing rent. Then they could potentially be getting close to $1 billion in annual income. That would be about $17 per share of income. Now take out their expenses of about $5 per share. Look, that's just a bit of an estimate. And it's now $12 per share in income. So let's give that a fair multiple of 12 and then multiply it by the $12 per share of income, and that means a share price of over $140. But let's be conservative and say they can only make around $500 million in income, therefore only about $9 per share. Now let's minus their expenses of that $5 per share, so now only making $4 per share in income. So that's $4 of income minus a fair multiple of 12, and that's a potential stock price of $48 in, say, the next 5 to 10 years. Okay, now what does all of this mean? Well, here are the scenarios as I see them. Scenario number 1, Seritage slowly runs into the ground and our investment goes to zero. The chance of this happening, look, let's be conservative and say 50%. Scenario number 2, well, Seritage sells a few more properties, but eventually develops their plans. Chance of this happening, maybe 40%. That gives us a share price of $48 in 2030. And scenario number 3, well, Seritage nails their objectives and everything goes according to plan. Chance of that happening is probably only 10%, but that'll see us a share price of $140 in the year 2030. Now, the current share price is $15. It's late November when I'm recording this. So, is the upside actually worth the risk? Now, I think yes, because it is an asymmetric risk, which means the upside is better than the downside. And it's all because of the share price being low. See, if the share price was $25, then the upside is nowhere near the same. One of my favorite investors is Mohnish Pabrai. He is a deep value investor and I have a lot of respect for him and how he analyzes and makes investments. He has been doing this for more than 20 years now with an incredible track record returning over 900% for his investors. So when I see a company that he has invested in, I take notice. And that's exactly why we are looking at Seritage. He currently only has 2 investments in the US. That's Micron and Seritage Growth Properties. I know how thorough Mohnish Pabrai is when making an investment, so for him to make such a big play into this company, well, it's a big tick of approval. He bought Seritage at an average price of $11.40. I think there is nothing wrong with copying the great investors. They have far more experience than most of us and have made far more money than most of us ever will. I actually think a very good strategy would be just to get the 13th filings from these best investors and copy literally what they do. You would save huge amounts of time researching the companies yourself, and you would likely get close to similar returns to these best investors. Probably the most underrated strategy out there and something I'm going to be doing a lot more of. So you might be thinking, why don't I just do this exclusively? Well, I do copy them a lot, but I want to improve myself. So one day I can be an investor like these legends, and I actually enjoy learning about the investments that I'm making. Now, another superstar investor that I like to follow is Spier. Seritage is a smaller part of his portfolio, but another tick of approval from an investor far smarter than me. He invested at about $37. That was very high compared to the current share price. Now that gives me more reason to think it's a bargain right now. And then we have Warren Buffett, the greatest investor of all time. He has a big stake in Seritage in his personal portfolio, not to mention Berkshire Hathaway holds all the debt as well. So if this isn't a good sign, I really don't know what is. So we have Mohnish Pabrai, Spier, and Warren Buffett, three of my favorite investors of all time, are just heavily invested in this company. Okay, now this video is already quite long, and normally I would pore over the finances of the company and check if they can handle their debt, are they growing, and are they a well-managed company. But Seritage, I already know, will fail all three of these areas. I can pretty much guarantee it. So do I want to invest in Seritage? But wait, like any investment, it comes down to valuation. What I mean is, if there is a pretty bad company, but someone said you can have the shares for free, well, they're free. You have no downside risk. So you obviously take the shares. So even a bad company is worth something. And I would say Seritage is a bad company right now, but they have valuable assets and a plan to turn these assets into something great. So for that risk, I also want a great price. Okay, so I think if the assets were to decline by 30% in the short term, well, the company is still worth $11.42 per share. But maybe they sell a few more properties in that time because they still have expenses to pay. Plus, there is a decent amount of risk. They run the company into the ground. So I think I would take the risk at a share price under $10. With a share price under $10, well, my upside is 5x to 14x over the next 10 years, which is roughly about a 17 to 30% per annum return. So even though I said I don't want to invest, well, I would at $10 because I understand the upside potential and I understand the downside as well. But I also like that some very smart people are big investors, and we should all take notice of that. This is a pure asset play, something that I like and it makes sense to me. If any of this is confusing, well, I think passing on this opportunity is totally okay as well. It is better to invest in something that you understand and you won't worry about it then. So maybe this investment is for you, maybe it's not. Regardless, thanks for staying to the end of this video. Let me know what you think of Seritage, as I'm very interested to hear other people's opinions. Hit subscribe so you don't miss any of my future videos, and I'll see you next time.